Hey guys, Ms. Herman here. I am going to be doing your videos for your lectures while we are doing this distance learning thing. So, first off, I just want to say I miss you guys. I hope that you guys are safe and doing well during this time away from school. I know I didn't get a chance to say goodbye to a lot of you before you left, so I hope that eventually I get to see you guys again. But in the meantime, my classes at least, I took a poll to see what adult topics they want to know about regarding financials and the economy. So this week, we are going to be focusing on loans and what type of loans there are, why do we even have this system of loans, all of that. So bear with me, one of the first videos I'm doing. Okay, more than welcome to follow along, take notes as you're going, but just know that this is not going into any kind of assessment. This is purely for your benefit of, at least for me, topics I wish that I had known before I graduated from high school. So, with that being said, we'll get into loans. So, first off, what are loans, right? So, loans are when the bank will provide you with funds and then you agree to pay back those funds at a later payment date. Um, there are a couple of different ways this happens, but why do banks do this in the first place? Why would they agree to give out money to people that they may not know very well? Well, primarily they can make money off of that. Okay, we'll get into that in the next slide of how they're able to make money off of this. But essentially, banks don't hold on to everyone's money all the time. Okay, they only hold on to enough to give out small transactions. So that way people can take out small withdrawals, right? So typically, you can't just go up to an ATM and pull out $50,000 out of the bank. They probably, while they have 50,000, they're going to need to make sure they have enough money to give out to everyone else. What they're doing with everyone else's money, because they're not thinking that you're going to come back and get it all the time, is they're loaning it out to these other people. Because you're not going to need that $50,000 at every moment, every waking moment. Okay, and this is a part of what happened with the Great Depression. All of a sudden, there was no trust in the stock market anymore. People went to their local banks demanding all of their money, and the bank didn't have it because they had given out these loans, right? And so a lot of people lost out on being able to gather up their money. Money wasn't worth what it was anymore. Okay. And as far as these payment plans, you can do it a couple of ways. With contracts, right? You're entering into a contract with a bank, signing that you agree to pay back this amount of money at a later date. You may pay it back in one single payment, okay, so one lump sum, or you may be doing installment payments where you're paying a little bit over a longer period of time. And this is probably going to be the type of loan system you deal with the most once you get into becoming a borrower, is that installment payment where you're paying over a long amount of time. So, again, back to why do banks do this? Well, they're able to put interest on loans that they're giving out. So they're letting you borrow the original amount, the principal that you are requesting, and when you agree to pay that back, they may ask you to pay back a little bit more as well, and that is what your interest is called. Now, on the good side of having interest with loans and being able to pull out loans at all, you have a large amount of money available to you that you previously didn't have. Say you're looking for a house. Say you're trying to pay tuition to go to college. You're not going to have just $100,000 sitting around, and all of a sudden the bank is able to loan you that money beforehand, and you're able to make these large purchases that you previously wouldn't have been able to. But on the negative side, in the end, you're going to end up paying back more than what you had originally borrowed. Okay, so it's this whole system of trade-offs where you have to ask yourself, is it necessary? And is it worth having this money up front now in return for paying back more later on. Okay, so for example, small example of interest. Okay, say that Mrs. Burgard comes to me before lunch one day saying, "Oh, Miss Herman, I forgot to bring money for lunch. Is there any way that you can front me $5? And I tell Miss Burgard, "Sure, I'll give you this $5, but you better pay me back on Friday. And I want $6 on Friday." Okay, so I'm asking her to pay back that original $5 as well as that collateral of adding on an extra dollar. Okay, so then Mrs. Burgard would have to think, well, is it worth it? I'm getting my lunch today, but I'm going to have to pay back Miss Herman that $5 and an extra dollar by Friday. Okay, same thing with mortgages, same thing with student loans, all of that. Okay, same kind of system that we've got going on here. Okay, so how do banks or lending companies determine how much interest is going to be and what percentage of interest they are going to ask the borrower to add on to that principal? Well, typically, the higher the dollar amount the loan is, and the more risky a borrower is, the higher the interest rate is going to be. Okay, so what is a risky borrower, right? Well, they're typically going to be young adults. Unfortunately, you are all risky borrowers at this point. Even I am still considered a risky borrower at 25 because I don't have a ton of credit history, right? I have never had a credit card in my life. Maybe not a super great choice on my part because I'm also not getting any credit. While I don't have any credit card debt, I'm not building up my resume, my trustworthiness for when companies are going to be looking at me. Same for you. You probably don't have a credit card at this point. You may have a debit card that your parents have set up for you where it's pulling directly out of your account, but most likely you don't have a credit card. So as a result, when you start filling out loans for student loans and tuition, stuff like that, the bank or the lending company, they're going to see you as having no history. Now, it's not a bad thing, but it's not a good thing either. Okay? Other risky borrowers are going to be people who have previously had problems paying on loans. Okay, so for example, I knew during the recession in 2008, a lot of families had a hard time paying on mortgages because the housing market was fluctuating. And as a result, they had to take out extra loans and maybe they had a hard time paying back those original loans. And so those families that were affected by that kind of issue, they're going to most likely have a higher interest rate on loans they take out in the future. Okay, so what is good interest versus bad interest? Well, good interest is going to be somewhere between 3% and 6%. That is really good interest, okay? If you get an interest rate for a loan at this amount, you're doing really good. On the other side, if you are getting an interest set on a loan for 9 to 12%, that's going to be a little bit harder to pay back, right? So for every dollar you're paying, you're going to have to also repay $1.12, right? Now times that by 1,000, times that by 15,000. Okay, you see how that kind of adds up a lot quicker than that 3% amount. Okay, so there's two types of interest. These agreements on interest when you are taking out a loan. There's simple interest, where you're only being asked to pay on the principal. You're only paying interest on that principal amount, right? Or you have compound interest, where over time, you're also paying on the interest that has accrued. Okay, so you're paying on the principal and additional money that is also adding up. Okay, if you are curious in playing around with what different interest rates look on different dollar amounts, highly recommend this website. Okay, this calculator is able to look at different types of loans. So, for example, this was for an auto loan, right, for getting a car. So you can play around with how much, how long you want to repay for, and then the interest rate. This would give you a good idea of what is good interest versus bad interest. So, getting back to that simple versus compound. This is simple interest, right? Where you're only paying on that principal over time or that original amount that has been borrowed. So, looking at from year 1 to year 2, right, you're only adding on $5 each year because you're only putting a 5% interest on $100. Okay, so over time, it's going to add up only $5 per year. You're only paying on that original principal amount that was taken out. Whereas with compound interest, you're not only paying on that $100, but now you're also paying on the 105. You're paying interest on the 110. You're paying interest on the 115. Okay, and so it's going to add up quicker over time. Again, looking at that loan of $100, the difference between compound interest and simple interest, if we go back to our other slide, 125 versus 127, it looks small. But you have to remember, a lot of the loans you're taking out, they're big, right? We'll get into the cost of how much loans can typically cost, but you have to remember this is comparative. Okay, so what kind of loans are you going to experience most likely within your life within the next 10 years? You're probably going to see mortgages, you're going to see student loans, and auto loans. Okay, so I'm going to touch on mortgages and student loans the most because these can be the most confusing or maybe you haven't heard the most about them. Okay, so starting with a mortgage. This is a loan that is used to buy real estate. Okay, so if you're buying a plot of land, you're buying a house or a building to start a business in. Okay, they're typically going to ask for a down payment along with you applying for the loan. So, take for example, Ryan and I are looking for houses right now, and we are trying to determine how much can we afford to put as a down payment on different houses. So, say we are looking in Marshall, we see that there's a house on the market for $200,000. Okay, that's obviously above our budget right now, but makes the math simple as we go. We can only afford a 20% down payment on a loan. That's typically what they're going to ask for, is a 20% down payment for any kind of mortgage loan. Okay, so what is 20% of that 200,000 house that we may be looking at? Okay, so you take that 200,000 times it by 0.20, which is that representing that 20%. That means that we would have to give the bank $40,000 down in return for them agreeing to give us that money for the rest of the payment on the house. Okay, mortgages, it's kind of hard to get there for that loan. Typically, your repayment time for a mortgage is going to be 15 years, 25 years, or 30 years. It's a pretty big investment. Okay, it's a big loan to be looking at. Okay, so the next type of loan that we're going to go over is student loans. Now, what all goes into the cost of student loans? Well, you've got housing. Okay, whether you're living in a dorm, an apartment, whether you have a food plan or just trying to buy money from the grocery store every month. Okay, transportation. So do you need a car to get back and forth between classes? Obviously, books are always going to be one of those costs. And then tuition. So we're going to really break down tuition here because how much you ask for in a loan is not cookie cutter. It's going to depend on your situation a lot. Okay? So it's going to depend on the type of college that you go to, whether it's a public university or a private university. Public universities are going to be less money in tuition per year than a private university. So a couple of examples we've got here of a public is CMU, MSU, U of M, GVSU. Some of those private universities here in the state of Michigan is K College, Hope, Aquinas, Davenport. Okay, so that's a difference of $10,000 between public university and private. So that's going to change how much you may ask for when you're filling out student loans. Years of school. What kind of degree do you want? That can change the amount that you're asking for over time. An associate's degree, about 2 years, okay, compared to a doctorate where it's going to be 8+ years, where you're getting your undergrad, you're getting your master's, getting your doctorate, doing your residency. You have to pay for all of that kind of stuff. And where are you going to get that money from? And finally, kind of looking at some of the big determinants of how much you need to ask for in student loans is, are you going to school in-state or out of state? So, you as someone who's living in Michigan, if you were to want to go to MSU, the tuition per semester, per year maybe, is about $14,000. Okay? For someone who lives across the border, say they live just over the line in Indiana or Ohio, it's going to be about $39,000, $40,000. Okay, so if you're going out of state, it's going to cost a little bit more than if you chose a college in-state. So all things to think about as you are getting into requesting a dollar amount for student loans. Okay, so as far as loans, I'm going to break down how you're able to pay back or what kind of money assistance you get for tuition and going to some kind of postgraduate program. Now, when you ask for a loan from borrowers, they're typically going to require that you get a cosigner because you are too much of a risk as a young borrower. They don't know you. They don't have any record of how well you're going to pay back this kind of stuff. So they're going to ask younger borrowers to get a cosigner, typically a trusted adult, that if you are not going to pay back the loan, then that lender is going to start sending bills to the cosigner. Okay, a lot of times people choose their parents as these people. I know that some of my family members have had aunts or uncles be their cosigners. Okay, so some kind of trusted adult in your life. So, what ways do we pay for education? In this day and age, I'm going to go over each of these. We have grants and scholarships, federal loans, and private loans. Okay, so types of loans, start with grants first. Grants are money from the government, and this does not need to be paid back. Okay, so grants are money that is coming from the government, does not need to be paid back. These are typically situations for students where they are in some sort of situation of need, where they are coming from a homeless situation, a family with low income. Maybe your parents are divorced and you have a single parent that is paying for all the bills in your household. You got multiple siblings, okay? Whatever those situations are, you're able to get government assistance in order to continue your education. So you have to apply for grants through the government websites. Next, you have scholarships. Again, this is money that does not need to be paid back. It's typically going to be money from your local community, different projects that are happening in your area. It's typically going to be a competitive process where you have to write an essay, do interviews, whoever has the best grades, that kind of stuff. Like I said, community-based. And sometimes with scholarships, just forewarning, some groups may ask you to verify what you've used their money on. So when I was a senior in high school, I got a lot of scholarships. And in order to keep that money or not have to repay it back for one of the groups I was able to get a scholarship from, I had to send them a receipt of my books from that semester that I had used their money on. Okay, not all scholarships will ask you to do this, but you may want to check with whoever you have received scholarships from. And finally, for stuff that you do not have to pay back, some colleges will offer work-study opportunities where you will have an on-campus job in return for student financial aid. Okay, so this may be working at cafeteria, doing janitorial services in different dorms, things like that. Okay, so check with your colleges, check your status. Okay, you're going to see that kind of stuff on your FAFSA website. Okay, so finally getting into the stuff you do have to pay back, unfortunately, right? You're borrowing that money, have to pay it back. Okay, for student loans, how do you borrow money? Who do you borrow it from? Okay, let's start with federal student loans first. You're going to know this later on, maybe as Navient. That is the name of the company that is the federal student loan provider. So these are going to be your direct loans, your parent loan for undergraduate studies. Those are mostly the ones that I know I interacted with, so I know the most about those at this point. Okay, those are going to be where you're getting that cosigner of a parent on there with you. So how do you get to that? You're going to apply through the free application for federal student aid, otherwise known as FAFSA. If you don't know what that is, please go to this website, fill out the information, have a guardian or parent sit down with you, because they're going to need a lot of your parents' information. This is where the government is able to see, do you need those kind of grants that I was talking about earlier? Do you need financial assistance? How much should your parents be paying towards your college education each year? Okay, so they're going to look at all of that kind of stuff. And based on your application into FAFSA, which I hope you guys have all done already at this point, and this is all familiar news, you're going to be offered either subsidized or unsubsidized loans from the government. Okay, subsidized loans is where the government is paying on that interest while you're in school. You're typically going to do what's called defer your loans, where you say, hey, I will pay this back, but I need to wait to start paying on my loans for 4 years because I'm in school and I don't have time to get a job. Okay, that's pretty common right now. So the government is paying on that interest while you're in school. That's a good thing. We want that. You also have the chance to get unsubsidized loans where the government is not paying interest while you're in school. So going back, think about that table where we looked at simple interest versus compound interest. You're accruing money even if you decide to defer your loans for a couple of years or so until you're in a spot where you can pay back on that loan. Okay, so again, you need to consider all of these things while you're agreeing to loans, student aid, preparing for that next step in life. Now, you don't always get all of the money that you need from the federal loan provider. So what happens if you don't get everything you need? Well, you go to your private student loan. Okay, one company that is well known by people right now is Sallie Mae. So maybe you have an older sibling who's in college already and they are taking out loans from Sallie Mae. This is not a part of the government. This is a separate company, but they work primarily with education loans. Okay, so they're a private borrowing institution. Unfortunately, they're typically going to have a higher interest rate than your federal student loans, and they're going to have less payback options or repayment periods. Okay, so something you should know is with student loans, if you work for a service industry through the government. So for example, I'm a teacher. I'm technically an employee of the state government. Navient has agreed that after 10 years of me being in this kind of service job, after that 10-year mark of me paying on my student loans, whatever is left, they will pay off the rest of it. Okay, so it's a way for the government to give incentives for people to get into government service jobs. Okay, Sallie Mae doesn't do that kind of stuff. Navient, you can push off your loans to a longer payment period. So I could go in right now to my Navient account and apply to change my 10-year period for payment to 25 years, right? Lowering the amount I pay back each month. Sallie Mae doesn't give that kind of option. What you agree to at the very beginning, so 10 years, you have to pay back your amount in 10 years. Okay? There are different options later on for deferment, where if you lose your job or you're not able to pay at the moment, you're able to push off your loans, okay? But that's not something you want to do all the time, because that's going to result in some bad credit history. Again, all of this stuff goes into history that then other lenders down the road are able to look at, okay? So we're going to get into, over the next 4 weeks, we're looking at loans, banking, credit. Okay, I talked a lot about credit today and how that's going to affect your interest for loans. We'll get into how do I even get credit, what's good credit versus bad credit, all of that stuff, and then taxes. Okay, so these are the big economic ideas that we believe you're going to see the most. This is what we see students having the most questions with once they're out of school. So hopefully over the next couple of weeks, you are able to get a chance to maybe ask some questions. You know, what does this loan mean? Or, hey, I'm going up north where tuition is this. What are ways that I can help try to pay for this amount? Okay, feel free to ask me. Feel free to ask Mr. Swatton any of these questions along the way. We are here to help you guys finish out your high school career, and we would love to hear from you guys. So keep an eye out on Google Classroom for assignments. They're going to be uploaded every day during the workday. If you end up getting the paper packets, please try to look up these videos. It would be awesome for you guys to look at it. We will be reaching out to you, so stay tuned. See ya.